In this chart, we can see an advanced price action setup that combines a rising wedge with a bearish pennant pattern. The market first moves upward inside a rising wedge, where both the support and resistance lines are sloping upwards, but the slope of the support is steeper. This is a bearish pattern because it shows that buyers are losing strength as price climbs higher. The supply zone is confirmed when price repeatedly rejects this level, and eventually we see a breakout to the downside. After the breakout, price forms a bearish pennant, which acts as a retest of the broken structure. The pennant provides a second chance entry after the breakout, signaling further downside movement. Traders are advised to enter after the breakout from the bottom of the pennant and take profits on previous trendline support zones. The first take-profit target is labeled as TP1, which aligns with historical support areas. This combination of the rising wedge and bearish pennant highlights how price-action traders can use confluence of patterns and zones to plan high-probability trades with clear entries, retests, and take-profit levels. In this chart, we are looking at an advanced price-action setup that combines the three drives pattern with a falling wedge formation. The market first creates three consecutive drives to the upside, labeled Drive 1, Drive 2, and Drive 3. Each drive pushes the price higher, but shows signs of exhaustion at the top, which often signals that the bullish momentum is weakening. After the third drive, price starts to decline and forms a falling wedge pattern. This wedge acts as a retest back into the key support level, confirming it as a valid demand zone. Once price consolidates within the wedge, it breaks out strongly to the upside, creating a long bar breakout which serves as the entry signal for traders. The strategy here is to enter on the breakout and target previous highs as take-profit levels. TP1 is placed near the second drive's high, while TP2 aligns with the top of the third drive. This setup highlights how multiple patterns coming together, three drives, falling wedge, and breakout confirmation, give traders a high-probability trade opportunity with clear entry and exit levels. This chart represents the distribution phase in price action, which typically appears after a strong bullish trend. In the beginning, the market creates higher highs, HH, and higher lows, HL, showing strong upward momentum. However, after making a new high, the price fails to sustain it, signaling weakness in buyers. This leads to a break in market structure and the distribution phase begins. During distribution, price consolidates in a sideways range, where big players offload their positions to retail traders. This often forms patterns like a double top, where the market tries to push higher twice but fails, confirming resistance. After this consolidation and distribution phase, the market loses its bullish strength and transitions into a bearish trend. The breakdown from this zone results in a sharp move downward, marking the beginning of a new bearish phase. In short, distribution is the turning point where the trend shifts from bullish to bearish, and recognizing it early allows traders to position themselves before the big move down. All right, everyone, let's break down this chart. What we're looking at here is a textbook example of a trade setting up with multiple layers of confirmation. First, price has clearly found a major support zone, a critical area where buyers have consistently stepped in before, halting previous declines. This is our foundation. Now look at that recent candlestick pattern right at that support. It's a Pi bullish harami. This is a key reversal signal where a large bearish candle is followed by a small bullish candle completely contained within the body of the previous one. It tells us that the selling momentum is exhausting and buyers are starting to push back. Adding even more weight to this bullish case is the long upper wick, or as it's often called, a pin bar, on that second candle. This long wick shows that price was rejected at a much lower level, a clear sign that the sellers tried to push it down but were aggressively overpowered by buyers, who then drove the price back up to close near the open, and the label says it all. Win Lao likely stands for window long upper wick, pointing out this precise, high-probability entry signal. So, when you combine a strong support zone with a bullish harami reversal pattern that also has a long upper wick, you get a powerful confluence of signals suggesting a potential move to the upside is imminent. This chart is a classic example of a high-probability bearish reversal signal, formed by the powerful combination of two distinct candlestick patterns occurring at the same price level. We first identify a pie tweezer top, which is a pattern formed by two or more candlesticks with highs that reach the same or very similar price level. This creates a clear ceiling on the chart, indicating that buyers tried twice to push the price higher, but were rejected both times at that exact resistance point. The second and most crucial part of this combination is the bearish engulfing bar pattern. This occurs when a bullish candle is immediately followed by a larger bearish candle that completely engulfs or wraps around the body of the previous day's candle. This signifies a dramatic shift in momentum, where sellers have not only halted the uptrend, but have aggressively overwhelmed the buyers from the previous session. When these two patterns, the tweezer top and the bearish engulfing, form simultaneously, they create a potent sell signal. The convergence provides a strong confirmation that the uptrend is likely exhausted and a downward move is beginning, as it shows rejection at a high price, tweezer top, coupled with a surge in selling pressure, bearish engulfing. The labels sell and sell signal on the chart clearly point to this confluence as the trigger for a potential short trade. This chart provides a fantastic visual narrative of a classic market reversal, illustrating the shift from a bearish downturn to a new bullish impulse. The story begins on the left with a clear distribution phase, marked by two distinct lower highs labeled top 1 and top 2, which establish a weakening uptrend. The bearish momentum then takes full control with the appearance of the three black crows pattern. This is a powerful trio of long consecutive bearish candlesticks that signal intense selling pressure, leading to a decisive breakdown from a key supply zone. This breakdown confirms the sellers are in charge, and the subsequent strong breakdown candle solidifies the bearish trend. However, the plot twists on the right side of the chart. Just as the downtrend seems dominant, we see the emergence of the three white soldiers pattern. This is the bullish counterpart to the three crows, three strong, consecutive bullish candles that indicate a forceful reversal and the potential start of a new uptrend, as buyers have aggressively stepped in to overwhelm the sellers. This chart perfectly captures the constant power struggle in the markets, using these key candlestick patterns to signal major shifts in momentum.